The Pro Show is brought to you by Rockin' Media and our proprietary Flash HDR photo process, providing you with the best, most realistic photos of your property. See the difference at rockinmedia.com. Hi, and welcome to the Pro Show. I'm Rick Machle. We have Kristen and Nancy here to talk about caveats, because everybody thinks that something just happens, or I hear something and I can do it, but there's always lots of caveats, especially in this market. That's next on the Pro Show. Well, here we are again on another Pro Show with Nancy and Kristen. Kristen Buono is from KB Real Estate and Lending. Good morning, Kristen. How are you?
Hello. Hi, Rick. Hi, Nancy. How are you?
I'm doing great. And Nancy Alexander's from Smart Mortgage Services. Hi, Nancy. How's it going?
Good, Rick. How are you?
I am doing well. We have made it through. I think it's been about a month since we talked. And, what ends up happening when we talk mortgages is everybody wants to say, I've got this thing, or I heard this from so-and-so. And I think it's important to really point out that it's not a lot of times it's a round peg in a square hole, or vice versa. And what we want to do is figure out, how do we shave off that square peg so that it fits in a round hole, or whatever. Just so I guess it's kind of talking about fine print or caveats, and so that everybody doesn't walk in and go, well, I know I can do this because I heard X. So let's talk a little bit about how some of these things may change and impact whether you actually do qualify for that mortgage, or how do you better qualify for a mortgage. Does that sound like a good topic to talk about today?
Excellent.
Okay, well, cool. Let's take an example of somebody who's got decent credit, not great, but needs to improve their credit score, that sort of thing. And I heard, people with under 700 can still get a loan. What are some of the caveats? You guys take it away.
Well, and people under 600 can get a loan too. But again, it's the caveats. And it's okay that they're round pegs in square holes, because everyone's going to have a different situation. But it's just asking more of those questions. And, Nancy, I know, had a couple of
an example. Yeah. Didn't you have one, Nancy?
Yeah. In fact, I called Kristen on it because I was like, okay, am I missing something? Because we've been in the business forever and ever. It seems like ever and a day and a day and a day. But there's still, the guidelines change all the time. So had this lovely client, 660 credit score, in the mid 660s, not bad credit, not great credit, wanting to buy a large parcel with a home on it, really kind of constituted on what we call a hobby farm, 35, 40 acres, and only wanted to put about 5 to 10% down. So you take each one of those. Kristen was like, "Oh, ouch," and I said, "I know, right? But you think you could get it done, because again, the credit wasn't bad,
right?
10% is a good chunk of money when you're, talking a purchase price 700,000. That's 70 grand, 60 grand, whatever your purchase price is. But when you combine the three together, it was like, well, Nance, we'd take it if." Right? If the credit were better, if there were more money down, or if it weren't this 35, 40 acre parcel of land. And so again, this is what Kristen said to me was, "Oh yeah, you got those caveats, right?" I was like, that's exactly right. You do.
So many different arms and legs to it. And it's not that it's not doable, but there is some conversation. It was interesting. Right after I talked to you, I had a similar situation, moving out of California, retiring in South Carolina, has a dozen rental properties, found this beautiful home, offers accepted. I'm diving into it. And then I realized, I pulled up the property, and it's on 45 acres, and there's a little turkey farm. And he only wanted to do, maybe 10% down. but I've got all this investment money, blah, blah, blah. So again, it's like, okay, so do you look at all the documents? Do we go stated? So that's where the caveat comes in. We can do it, we'll figure it out, but it's not a quick yes, no. I think that's the main thing.
Yeah, and Kristen, it's price, right? What it hits is, again, we've said this before, the lender has one commodity, right? One commodity that they sell, and that's money.
Right.
And in turn, if they see or feel that there is a greater risk for their rate of return on their money or return at all on their money, right? Then they're going to charge the consumer, this individual, a higher rate. It's going to become more expensive. And so I was looking at 8.5, 8.75. Now, if I have 20% down, I'm down to 8. If I had a 720 credit score or better, I'm down to 7.5. Right. So it's like, again, if you're willing to pay, can it get done, like you said, Kristen, and you've got to slice it and dice it and kind of flip it to the left.
Yes, you've got those puzzle pieces that you're putting all together.
Yeah.
Again, just educating the borrower because, well, Dr. Google says this, and we've got all those experts on, every news channel out there and every finance channel out there. Have you tried this? Have you tried that? So
had a lovely one the other day that a gal said, well, Nancy, can my loan be manually underwritten? Because Dave Ramsey says that it can be. And I had to think for a second, in the sense of saying, number one, Dave Ramsey is no question, excellent at what he's done for our society when it comes to debt and bringing debt to the forefront and the penalty we pay, the extreme penalty we pay for excessive debt. But I'm not sure he's ever written a mortgage loan.
Well, and just to dovetail, a manual underwrite typically is not a pretty file, and you're asking for the underwriter to dive into the minutia and the details of why they should give you the loan, even if you don't have the qualifying credit score. Hence, they're looking for compensating factors. They're looking for this and that. So, yeah.
And again, it was a great conversation, and it's a great door opener to have that conversation with the client, as to say, it's a great, let's talk about it. Let's talk about a manual underwrite and the pros and cons of a manual underwrite and why we want to do everything we can to stay away from a manual underwrite, right? We want that automated underwriting finding,
right,
etc. So I love the conversations because they do open up different doors. Right, but it is interesting. There was something, Kristen, that I heard the other day that I looked into a little bit more, and it was fascinating. So these states that have been devastated through natural disasters, right? Flood, fire, tornadoes, etc. So you've got an individual moving out of California, out of the fire region that hit, 4 months ago, 5 months ago, right? Devastated portion of California. And in turn, they're moving to Colorado. They're buying in Colorado. They can use, in a sense, the devastation, the fact that they're coming from a devastated area into Colorado, and their loan in Colorado can be 100% financing.
Oh, wow.
This is new, that is coming out through NMLS, through Fannie and Freddie this year because of all of the areas of devastation. That's a big deal.
That's a big deal.
That's a big deal.
Side note again. I'm going to side note.
What are the caveats?
No, but does that make sense? Like, I get it, but that will be a higher payment. What is the interest rate going to look like? No one, you don't get something for nothing, so more information, more questions, which is good. And I love that we have the options. Like I've said, vanilla is sometimes a great flavor, but we have rainbow sherbet too, and we got to have all those different choices. So I I think it's great that we as an industry have pivoted and shifted to, create the opportunities for those people who, had devastating losses.
Right, right. It was interesting. It's just come out this year, and I thought, and again, it's no different than doing a USDA loan, 100% financing, and people that want to pick it up. Great loan if you can fit into it. It's
That is a box.
strict box for debt to income, for how many people in the household have
Yep.
income, etc. Number one, does the house qualify? Right? That's your first thing. Same with VA as far as 100% financing. However, I still go back and say that VA loan is the best loan on the planet.
Best loan. Yep.
Best loan on the planet. If you're a veteran, you get a 0.5 point off on your interest rate, 100% financing. If you've got the 10% disability, no VA funding fee, no penalty. I mean, it is just, it is
As it should be, though.
gift.
I mean, it
should be.
should be. Yeah, as it
It
should
should be
You
to
know.
our veterans, right?
Yeah,
Let's talk
absolutely.
real quick about a good income hack, a good credit hack,
Yes.
as to what do you tell your clients to think about?
For
Look
credit,
at debt,
Yeah.
like
debt. Yeah. So few different things. It's interesting because I have a lot of people, well, I don't have any debt. I don't have any debt. Okay, yay, no debt. But your credit score is 650. We need some debt. You got to show the lender that you can pay back the money that a creditor is letting you use short term. So so get the credit card. The new legislation that's gone into effect where they can, I guess, when it all gets rolled out, the landlord can now put a credit rating for the rents on the credit report.
But again, be careful with that, right?
Yeah.
Because isn't it Experian that says, okay, you can put your cell phone bill on, you can put your
Your electric bill.
you can put your rent bill on. But the problem with that is, again, here's the caveat. I love the
Yeah.
word. It must be the word for today. The caveat is that when you owe $110 on your phone bill,
Mhm.
it shows on your credit report that you owe $110, and that's 100% of your payment.
Correct.
Right? There's no 30%, 40% of what you owe. So it can affect your credit score in a negative way versus a positive way if we're not pulling at the right time, because remember, credit is fluid.
Right.
So, Nancy, can you explain a little bit more about that 30%, what that means?
Well, one of the, credit is dialed in if you look at a pie and you say, okay, this third of the pie applies to how much do you owe versus how much the credit provider has given you. So let's say, for example, you've got a credit card with Chase or with Capital One or Discover, whoever it may be, and they've given you a $10,000 limit. So 30% of that number would be $3,000. So you want to keep your revolving balance at or below that 30% to get the best rating in that piece of the pie. Another piece of the pie is how many, like Kristen was saying, how many pieces of debt do you have open? Student loans, car payments, credit cards, right? The optimal, which not many people can hit it, is 3.
Okay.
Yeah.
Well, that's pretty difficult. If you've got 6 student loans, well, you've blown that, right? You got a car payment, you're up to 7. You got 2 credit cards, you're up to 9. There's very few people that have 3 or less open lines of credit.
Credit.
And
if they can't, so then if they have no credit and they try to get credit and they can't, now you're using the, Rick, to your question, the secured card. Okay, well, I've got $300. If I give $300 to the bank and I use, I spend it and then I bring it down to, that 30%. The other little hack we talked about was on those, you have the $10,000 card and you want to spend and then pay it down, but pay it like every 10 days. It's almost, you will
you speed it up tremendous. I mean, I've seen
work it up.
people
Yeah.
create credit from the 600s to the mid sevens, high 700s by doing, that's a great hack.
Yeah.
And don't wait for that paper statement to come in the mail. Jump online, pay that bill, go charge your groceries, right? Your $200 and turn around and pay it down to $20 remaining. You don't necessarily have to pay it off. Leave a small balance, like
Yeah.
Kristen said in the beginning, right? Show that you have the ability to charge, to create debt, and then to pay that debt and continue that cycle. That really is what credit is about, and building that credit score.
But it's total credit, right? So like you want to keep your total available versus total used less than 30%.
Right.
So,
Yeah.
but don't student loans, isn't that always 100% available and 100%
It
used?
is. It
Because
is.
it's not like, well, I could have taken out 120 grand, but I only took out 60. Well, as far as your credit
You're never
score,
going to see that. You're right. Right? You're never, and that's the killer about student loans. The other thing is that as a consumer, will consolidate a student loan.
Mhm.
Yeah.
However, the credit report never will.
No.
If you got 16 student loans,
Yeah.
it's going to list all 16 student loans, even though you as the consumer say, I make one payment of $682.
Yeah.
So then we as the loan officer go through those 16 loans and go, does this compute to $682 that the client is making? So you're right. That hack is for credit cards, student loans. I don't know a hack for other
Yeah.
than pay them.
Same with
Yeah.
if you're trying to get an investment property, right? And you've got your mortgage. I mean, you may have paid down 30% of it, but of course that's probably a little different because the mortgage is based, Kristen, on value, right? Or what it's worth, correct?
Right. Right. We talk a little bit, you mentioned paying the credit card every 10 days. Back in the day, remember we had all those, the biweekly payments on your mortgage and
Right.
pay it off quicker. And, now you definitely aren't seeing that. At least I'm not seeing it, Nance. I don't know about you, because obviously, the mortgage, the mortgage companies don't want you to pay it off because that's how they're making their money.
Exactly.
Honest
They're
here.
not encouraging you to pay it down.
No, not at all. But from a strategic standpoint, if you're in the situation where you do want to pay that off sooner, then that's another little hack. You pay X amount towards principal, or you do that biweekly payment. You don't, you pay it.
And there are those third-party companies out there that will do that bi-weekly payment for you. You have to pay to set it up, mind you.
Right.
Right. I think the other real killer to debt is a brand new car.
Yeah.
Right. You go out and you spend 80,000. I was going to say 40,000. Does that exist anymore?
I think so.
Yeah,
For 40?
you could get a good Subaru for 32 for 32. That's what I buy, and then I drive them to death. But anyway, but yes,
I love it. I love it. So let's say we'll split the difference. And let's say the car is 60 grand.
sure,
Right. Let's say, Kristen or Rick, you put 30,000 down.
right,
Right. It's not going to show on the credit report that you're at 50% loan to value.
No.
true,
Because you pay 50% of the price. What it's going to show is that debt is 30 grand.
30 grand.
You owe 30 grand. You just took it out as of June of 2025, and your credit scores are going to drop 70 basis points because you just added 100% of debt at 30 grand. As the credit report shows, but yet you and I both know we put 50% down.
Right.
So that's a killer. Last but not least, I want to throw in, for every $100 worth of debt one possesses, you lose $10,000 in buying power.
Say that again.
Oh, for the purchase. Oh, yeah. Okay. For
Right.
buying. For
So you've got a $600 car payment,
Right,
right? You're losing $60,000 in buying power.
okay,
You're trying to prove
purchase price.
for a $800,000 home.
hmm
Right? So do you ever, Kristen, look at somebody and say one of the quickest ways to get that DTI, that debt to income, under control, right, is to attack debt?
Right.
Because of the buying power it takes away. That's again where the lovely Dave Ramsey comes in and talking about people having debt, is that, you can make 40,000 a year and have no debt and get qualified for more than somebody that
Right.
makes 80,000 a year, has 2 car
Yes.
payments and 3 student loans. Because the debt eats away so much at your buying power.
Mhm.
It's exponential.
Yeah. No, absolutely. And we go through that. It's like, well, but what if I just put more money down? Okay, well, I don't know
It
that.
barely moves the needle.
Yeah, it barely moves it. Let's look at, okay, you've got
Income,
this debt and you have that debt. Let's see how we can play with those numbers and then
right?
see how the buying position improves. And then, maybe have some left for savings. Like, don't wipe out everything to buy the house. Like, you want to have some savings left as well, just as a cash flow
And
situation.
I love that. What you're saying is that, I think it was Buffini that brought it up years ago and said you can either look at things as an either or.
Uh-huh.
Either I can spend all this money or I have to save all this money.
Right.
Or what if you took on a both and mentality?
Mm-hmm.
I can do this and I can do this in what do we call it? I can't think of it. In minimum amounts. I'm trying to think of like,
Yeah, and minimum amounts, minimum payments, yeah.
yes, exactly. So we can have a little bit of debt. We can have this income. I don't want to say low income. Is 40,000 low income in today's world? Well, it depends on what you're
Depends on
trying to
what you're
do.
buying. Yeah,
Yeah.
yeah, it depends on what you're buying.
So what about those people that pay off their credit cards every month? Does that help or hurt?
I think it kind of,
I love those people.
I do.
Give me some caveats why it may or not may not.
Well, it's good news, bad news. It depends how long they've had the actual debt. So if they just had the card 6 months, that's gonna impact the score versus, maybe it's I've had this card for 5 years and I never carry a balance. I mean, that could impact the score too. So
Well, they always have a balance at some point,
at some point,
right? At some point, they've got a balance because you're looking at it.
As long as you're using it, as long as you're using the card,
Right.
yeah.
That's exactly right. As long as you're putting it into motion, you're charging on it, you're paying it off. So if you're paying it off every month, I mean, I love those people that come in with an 810 credit score. I almost say you're living life too right.
Yeah.
It's like, because it's unusual and it's a beautiful thing, but they've got 2 credit cards and they pay it off every single month. They use them.
They use them, yeah. Or they have, other accounts that have been paid on time
Right.
over the last 24 months, either the car or, the, Target or whatever it is.
Right.
They are paying it. They are paying it all off.
Right. Let's talk really quick about a non-occupant co-buyer.
What does that mean? Define
Well,
it. Kristen, define it.
basically borrower can't quite qualify on their own. So typically it's mom or dad or boyfriend or cousin, uncle, whoever, and they go on the loan, and they are added. Their income is added, their debts are added, everything's added to assist that borrower to be in the buying position that I don't want to say they want, because sometimes it doesn't make sense if they want something that's higher, but to put them in the position that's going to make sense for their budget.
So it's interesting because I talked to a mom the other day and she was like, okay, Nance, I'm ready to do this. I'm ready to jump on. And so I said, okay, well, let's discuss this a little bit. Let's make sure that you fully understand the ramifications of this and
what risks.
Right. What responsibilities you're going to be on title, you're going to be on the note, i.e. it's going to show up on your credit report, right? I'm not going to use any assets from you because we're not taking any assets, but I'm going to be using your income. Let's talk about what kind of debt you had. And all of a sudden she's like, well, I've got a mortgage in Hawaii and I've got a mortgage in California and I've got a mortgage out in New York. And it's like, oh, okay, I don't think this is going to help our cause necessarily, right?
Right.
Because
And yeah. And oh, by the way, one of the mortgages I have is FHA, and my daughter wants to get an FHA loan. So that presents
another
yeah, a
caveat.
caveat, but explanation, whatever that takes. So it's it's good news, bad news. And then the other conversation is, okay, this sounds great. Let's flip it. Let's say she didn't have those things, but she may want to buy something in 2 years, or she's going to retire, or she wants to get a second home or something else for her. That debt that you're assisting your daughter with could impact your personal buying position next time.
Absolutely.
And so it's just more conversation and thinking it through, and just making sure that it all makes sense for everybody.
Right.
So it's definitely possible to do what she wants to do, but
Maybe.
it's not necessary. Maybe, depending on how many mortgages she actually has, because that could be one of the caveats is whether she does that. But it's something that, as you say, you need to discuss it. You need to figure out whether it makes sense, because there are all these if-then. If you do this, then something else may occur. And that's really what a caveat is and one of the things you need to think about is if you do this, what else can it affect? And what are your plans? Like with the mother, what are your plans 5 years, 3 years, 12 years, whatever out? And will doing this impact that? And she may still decide that's the best thing because she's trying to help out her daughter. But, they need to know.
Yeah. And most of them, Rick, want it on a short term, right? How quickly can this situation change? In this particular case that I was talking about, the kids had a house to sell that had a good deal of equity in it, but the house couldn't go on the market. 5 dogs, 3 kids,
Right.
etc. They really wanted to move out of the place and get into the new place so the old place could present itself in its best light, right, Kristen,
Right.
as far as you being on the real estate side and
Yeah.
selling that piece of property. So what this was a Band-Aid that the mother was going to come in and bridge these two. And how quickly can I get out of this? Were we looking at a recast to take that chunk of money when the house sold?
Yeah.
Were we waiting for the
Refi.
refinance?
Mhm.
Right. And again, refinance, another caveat, 6 months, right? From the time you've taken the note out. And we say it's 6 months, but it's really not. It's 6 payments.
It's 6 payments. Yeah.
It's 6 payments. So remember, you close in August, your first payment's not until October. So you've got October, November, December, January, February, March, right? Before that refinance is going to happen. So if somebody's telling you 6 months, remember it's really 6 payments.
Payments.
Yeah, again, just that little tweak.
Well, and then it's risk. So then mom says, well, or the kids say, okay, yeah, thank you, mom. And now it's February, March, and maybe, the rates who knows what the rates are going to do? Who knows what the market's going to do? Is it going to improve? Is it going to stay the same? Who knows what that looks like? There's a cost to that. So
Absolutely.
more conversation of, to your point, there is a cost to buying money and borrowing money globally.
Right. And it goes back to what we've heard a lot, which is buy the home, marry the home, date the rate, that sort of thing, assuming rates are going to go down. But the caveat needs to be, but what are you willing to live with this if the rates don't go down? And if you're like,
right? Can you live with it?
Can you live with it? And what does it mean to your life? What does your life look like 3 years down the road? Oh, you want to have a kid. Well, that's an expense. So are you counting on the lower rate to do that? And maybe we need to look at a different home.
A lot of ifs, ands, buts, like you said, that, square peg, round hole. There's a few different things going
Right.
on.
And so, and I'm hearing a lot of that right now, where there are people who did that. They believed, marry the home, date the rate, whatever it is. And now they can't afford it. They shouldn't have listened. They should have done more research. They should have watched the Pro Show more. That's what I'm saying.
Watch the Pro Show. That's a good comment.
Because they would have heard you guys talk about this and go, you got to think about these things. And
well, and Rick, I think that when we all bought,
Right.
we're not 30, and when we all bought, I remember forfeiture. I mean, forfeiture was part of the game.
Right.
That it was, I think my house payment was like $850, and I was a student, I was a single parent, I was only bringing home $1,200 a month.
Right.
Right? It's like $450 had to come out of one paycheck, and 425 or $50, whatever, had to come out of another one, and the difference was what we ate on and had gas. And yes, things were cheaper, but everything was different. But
Right.
Good, bad, or indifferent, it's interesting because I hear more of, I don't want to be house poor.
Right.
Yeah.
For that 30-year-old, that 35-year-old, even that 40-year-old is saying, the one thing I don't want to be is house poor.
Right.
And gosh, there's some positive in that statement.
There's some sacrifices, like you said. You
because
have
we
to figure out.
we talk about real estate and the rate of return.
Mhm.
Right, the investment that real estate is, and I don't think that goes away, but it's got to make sense.
It has to make sense, and you kind of have to go, how is this going to impact my day to day? Am I willing to give up, my 2 annual vacation trips with my family? Am I willing to maybe not have date night every week, but if that means it's once a month or whatever that looks like? That sounds like minuscule, but $100 here, $100 there, it all, it all adds up, because there is that cost of home ownership. And yes, you're getting the long-term investment, you're getting the rate of, you're getting that equity built, but do I have a nest egg? What if somebody gets retired, somebody gets laid off? What if somebody gets hurt? You hate to go down those rabbit holes, but that's life. I mean, there's, to Rick's point, what ifs and if, ands, or buts, and you have all these different things going on the, in the puzzle of life.
Yeah. So it really doesn't just come down to rate. I saw you did a great video the other day.
Oh,
that was great. That was great, because you started it off to say, as so many people do ask, because they don't know, Rick, what question to ask.
Yeah.
The 3 of us have talked about this, is, what's the rate? And it's like, there's times you want to come back and say, who cares? Let's talk about your income.
Amen. Yeah.
What are your goals?
Yeah.
What your goals are and what you want to do.
Back to what we talked about last time with strategy.
Right. And it's kind of like saying, well, I want to buy IBM stock, but I want to sell tomorrow and make money out of it. No, but you took that money, you put it in IBM stock. It's not available for other things, but your hope is that it will make you more money. The cool thing is, with your house, over time, we've seen that you're living in your IBM stock. But you need to have the expectation that IBM stock may not pay off tomorrow, and it may cost you to have that, because you went and actually took out a credit card, in theory, to buy that IBM stock, because that's really what you're doing with a mortgage, right? In theory, yeah. Don't do that. But unless you expect it to get 50% returns. But
I should have been an economist. I loved economics when I was in school.
I think you are. I think you are.
I swear I love math
every day.
Oh my God, I loved it, Kristen. And the one thing that just the minute the professor said there is an opportunity cost, I was like, oh my God, this is right? This
Light
is
bulb.
another all over again. If you choose A, you forfeit B, C, D, and E. Does that go back to both and, either or? Well, you can incorporate those, right? But again, if you choose to buy the house, right, Rick, instead of the IBM stock, or can you do both and?
Mm-hmm.
Can I buy a smaller share of the IBM stock for my portfolio? And can I buy maybe a less expensive home to get started, rather than saying, well, the average price is $1 million, so I've got to jump in for $1 million.
Or do you buy that home that's a fixer-upper, spend some of that money, and now you're basically making improvements to an asset? It's like you're
Right.
adding, in our little analogy, you're adding computer code to IBM to make it better. And that's why your stock went up. And
You're right. They're nothing better than sweat equity.
yeah.
Nothing better than sweat equity. Get out there, make that lawn look good. You do the work to tear that wall down, make sure you're talking to somebody who knows what they're doing, but still.
Yeah.
You know.
But any other caveats we should think about? I mean, we talked a little bit up on the buy side, and probably, we could always go down that a lot with Kristen, but it's all tied together. They're like two sides of one coin, aren't they? Unless you got cash.
Yeah, no, definitely. And I think, Nancy, we chatted a little bit about this. Rick, we talked a little bit. I think we are seeing, we're seeing a little shift. We're seeing a little pivot. We're seeing a little
adjustment.
I don't like adjustment, correction.
Adjustment. I like that. Yeah.
Just a few different things going on. I'm taking a new listing today, as a matter of fact, and I've been watching it. And, 6 months ago, 4 months ago, we were probably 20, 30 grand higher than we are today. The good news is the seller's realistic. Sellers wants to sell it, but they want to, they're sitting on a good equity position. But they also know that, they're coming down. And then when they go buy their house, we're going to look at properties. We're seeing longer days on market. We're seeing homes come back on the market. It's an interesting, July 2025. We are definitely shifting a little bit. At least in my market, I'm hearing a little bit.
Same thing here, Kristen.
Yeah. And it's not a bad thing. I think it's a good thing. I think, as I told Rick, and I'll probably piss some people off, but I think we just got a little greedy the last 4 or 5 years, quite frankly, because we could. And now I do think that's getting normal.
More balanced.
Yeah, a little normal.
More of a balanced scale than what has been in the past. But that's what's interesting when people say, but I want to time this right. And it's like, well, Rick, I want you to tell me when to buy that IBM stock, right? Nothing is worse than it's like, okay, it's $100 a share, it's $280 a share, whatever. And you think, okay, I'm going to buy it. And the next day it drops to $240 a share.
Right.
It's like, do you get to call your broker and say, oh, cancel that order from yesterday, right? I want to buy it today at the 240 instead of the 280 of yesterday. It's like, it doesn't work.
I prefer to buy Apple stock in 1984 prices.
Yeah,
okay.
Exactly.
Go backwards. Yeah.
Same thing when we go to lock an interest rate. It's the same thing.
Right. I was thinking about that. Is should I lock? And what are the caveats if I lock? Well, it's a risk. Well, you can. One of the caveats is that you could have maybe waited a day and it would have dropped another quarter point in this market. Another option is it could have gone up a quarter point in this market. And because, I don't know, a tariff got put on. Just pick something out of the air,
Yeah, and that's really what it is. It's a day-to-day thing. There's no blanket rule except what you said about the Apple stock.
If you time it as perfectly as you possibly can, pat yourself on the back as often as you can, because it doesn't happen very often that everything gets timed to the sale is the right price, the buy is exactly what you expected, the rate is exactly what you wanted. I don't know. There is a thing that a girlfriend of mine says that I love, and I use it and think about it probably every day, that God and his angels conspire to give you exactly what it is you're asking for.
Amen, sister. Amen. Absolutely. I love that.
Yeah.
Exactly. Well, and it's this. what it obviously this whole discussion comes down to is you kind of need a buddy. You need a pal to walk through and talk what are some of the caveats, because nothing is cut and dried. Well, the cool thing is that one of the things you don't need to have a caveat on is whether you talk to Nancy or Kristen, because they will walk you through those scenarios and give you an idea as to what's the best way potentially for you. And if you choose X, what happens with Y. And so if you're interested in talking to Nancy, you can do so by calling her and walking through some of the scenarios, and she'll tell you all the different caveats, as will Kristen, and you can talk to her at the same time. And of course, one of the other caveats that you don't have to worry about is whether you're going to get good advice on the Pro Show. And we've got a lot of episodes out there that you can talking about this and lots of things relative to the market, what's going on in real estate, what's going on with mortgages. And as always, great having you two on. And I look forward to seeing you again next time. And we'll see everybody back here on the Pro Show.